Hi, everyone. Welcome to the KE Report in a special Sunday daily editorial, again with Marc Chandler. Marc is the managing partner at Bannockburn Global ForEx, also writes the Mark to Market website, which I will post a link to in the show notes. Marc, as we like to do on these Sunday editorials, is look back on the last week, recapping any key news or data points, and then look ahead to the next week. However, man, oh man, this last week, it was crazy busy. We had news on tariffs. We had economic data out of the US, a bunch of it. We had Trump's address to Congress. We had Powell speaking on Friday. And we had the markets continuing to fall and show this broad weakness throughout the week. And we also had the US dollar go through one of its worst weeks in years. Marc, usually there's one part that I want to start with, but quite frankly, I want to open up the table to you. What stood out to you this last week that seemed like day after day it was news story that moved markets?
Yeah, sure. Corey, this has been a difficult week. I think that not so much that I've lost money, but I've aged probably several years this past week. A couple of things stand out. One of them, of course, is this flip-flop on U.S. tariffs. In my work, I sort of compared it to that old joke from Woody Allen. He complained about a restaurant that the food was poor and the portions were small. And in some ways, most economists don't think that these tariffs are a good idea, that they're going to have like negative economic consequences, that we might bring back industry to the U.S. through manufacturing, through high tariffs, but we're not going to bring back jobs. Most of those new factories are going to be automated to a large extent. So the flip-flop on U.S. tariffs, but I think that even bigger than that, partly because of the uncertainty, partly because of these tariff threats, even though very little has really been implemented, it is having a cooling off effect. And so I think there is a bit of a growth scare in the U.S. I think people see the sharp drop in the stock market. The S&P 500 fell below its 200-day moving average for the first time, I want to say, in a couple of years. And this all like weighing on, so the growth scare weighing on stocks pushes yields down or lower than they would otherwise be. And this has helped sort of drag the dollar. So I'd say one big thing has been the growth scare in the U.S., partly fueled by the tariffs. But the other part of the big story this week is that the U.S. voted against EU security issues at the UN, siding with Russia a couple of weeks ago. This has scared Europe. And it's not just that Europe has depended on the US for military. Of course it was, but it was partly at the US insistence. It didn't want Europe to develop its own army, its own military. Now, different president, different interests. And the bottom line here is that Europe is going to spend a lot more money. There's going to be a lot of fiscal support, military Keynesianism, if you will, spending on defense, spending on security issues. And this has triggered a huge sell-off in European bonds. And when I say huge sell-off, I mean the core Europe, so Germany, France, talking about 33, 34 basis points this week, which is a big move. That puts, they say, the German yield at about 2.84%. So rising by 34 basis points in a week is a very large move for a usually stable, quiet, fixed income. What this has happened is that this means that a couple of things. One is that European downside risks, the tail risks to growth, have been removed or reduced. There's going to be more supply that also weighs on yields, or excuse me, weighs on prices, helps lift yields. And so this resulted in a narrowing of interest rate differentials, which in turn also undermine the dollar. I think those are the big things. I think that this growth scare in the US might be a bit exaggerated. I think it's based on a lot of people looking at the Atlanta Fed GDP tracker, says the economy is contracting at about an annualized pace of 2.4% here in the first quarter. And this seems to be an outlier because the ISM, the PMI, all are consistent with growth. Other economic data is also consistent with growth here in Q1. And so what happened? I think that we did have very weak consumption in January. I think that we're going to see later this month, we're going to see retail sales and personal consumption expenditures bounce back. And I think that the other factor was this huge trade deficit, huge blowout. And partly it was people trying to beat the tariffs. And we can see that from like China's trade figures. We can see that from Canada's trade figures, Mexico's trade figures. But there's also something else going on besides just trying to beat the tariff, but it may be related to that. If the US is going to put a tariff on imports, which is a real threat still, that would include, say, precious metals. And the US is a big market for selling the precious metals. And so we've seen large gold depositories like in London and Switzerland export gold to the US. Many people like myself think it's to really front run those tariffs, maybe a different way. But other people think it's have a more darker, more conspiratorial element there. But in general, I think that these are the three big things, right? The growth scare in the U.S. and why I don't think it's going to, why I think it's a bit exaggerated, the sharp backing up of European yields and the weaker dollar.
Well, Mark, there's a lot to get into there, and we maybe should get into each chunk of those separately. Let's maybe start with the U.S. growth portion. As we record this on Friday, Powell has been addressing people and saying that apparently they're not as concerned. They think the growth is okay. They don't feel like they have to really do a radical policy change, and they think that the effects of the tariffs may be a one-off effect, that it doesn't necessarily mean we're going to see a rapid increase in inflation, that some of that would get absorbed by companies, some of that would get passed along, but it wouldn't be a continuous chronic situation. Let's just focus on the US growth situation right now. Some people are already bannering stagflation has arrived. Other people are worried we're going to have a recession again, but that seems to happen every year for the last couple of years, and the recession still hasn't showed up. That GDP now forecast of negative growth has people leaning that direction. How are you actually parsing all this out as far as the U.S. growth? Are we going to grow? Is manufacturing growing? Is retail growing? Are the consumers not spending as much? What is the real picture here to take away?
Yeah, I think the real picture is that we really don't have enough data points yet. Most of the data that the Atlanta Fed is working on is still from January. And we know there was a lot of, there's several factors, including poor weather, that exacerbated the downturn in January. My best guess right now is that the economy is still growing here in Q1. And part of the trade deficit blowout, what's happening to those part of those goods that are being sort of front running the tariffs, that's going to go into inventory. So in effect, what trade subtracts from GDP, the net export function, the inventory, which is partly picked up in business investment, going to offset that. Not fully by any means. But so I sort of think that you have to keep your eye on the signal and recognize where we are in the data collection at the Atlanta Fed, which is not trying to forecast. It's saying based on the economic data that's coming in, that we have in hand, this is what it means for GDP. And I think that as that information set gets more full, as it gets more complete, and we'll see that in the coming weeks, I think that we'll get a bounce back in retail sales. We'll get a bounce back in consumption. We've already seen a little bit of a bounce back in auto purchases. And so, I mean, I think it's a difficult time, as transitions often are, and there's a lot of noise. And it's what we saw with the jobs data. People have been talking about the job cuts in the government, from the federal government, for some time. You know, basically, this is one of the things that Trump campaigned on, and Musk is sort of carrying that out. But what we've seen in the past 2 months, that is in January and February, we've seen a net growth of government jobs. A lot of these look like they're local government jobs, but we're still talking, say, 11 to 12,000 a month. And so I do think that the headwind is coming for the U.S. economy between the government spending cuts, program cuts, job cuts, curbing on immigration, the uncertainty surrounding the tariffs. I think that, and we've seen some debt stress levels, whether they're on card purchases, mortgages, credit cards. I think the economy is going to turn over. I just think that now we might be a little bit too early in that game. And the problem is that the sort of like the boys crying wolf, right? So for so long, people have cried about a recession's coming that lost a lot of credibility.
Oh, boy, did it ever. But you know what? There's always that contingent out there that's saying a recession's coming. We just heard more voices saying that over the last few years. But Mark, with all this uncertainty, and quite frankly, the US president that who knows what he's going to say day after day, and who knows just which tariffs are going to be enacted, and who knows if they increase or decrease, doesn't it make this whole forecasting, let alone a week out, but months out through the rest of this year, doesn't it make it almost impossible?
Well, I think that there are some things that like we can count on. I think that we can count on the government, the federal government, firing employees. We've already seen in the U.S. as the federal government workers apply for unemployment compensation, they go into a different program. And so right now, I'd say people are making a big deal out of it. But the initial jobless claims by federal government workers is at about 1,600. And so, but you'll see it in the media is talking about a fourfold increase. It's a fourfold increase from a very low number, 400. And even at 1,600, it's still a very mild number compared to the tens of thousands that are going to be laid off probably in the coming months. So I'm thinking, I think we've got to watch the data. We had a solid jobs number on Friday, and it's nothing to write home about, but it's just net little changed on month over month view, and that just is steady. It's slowing, but very, very slowly. So we need to watch the data, and I think the Fed has it right that when you've got still firm inflation and you still got a firm labor market, mixed data about the actual performance, a lot of uncertainty, the best thing to do is just sit tight or stand pat, as it were.
Well, Mark, how do you see this all factoring into the move we've seen in the US dollar? Because the dollar is always a double-edged sword. One blade is the US economy and the outlook and what's happening in interest rates, and the other blade is the counterbalance that you have to the other currencies, like what's going on in Europe or in Great Britain or in Japan. So, how much of the dollar move is because of some of these financial concerns, and how much of the dollar move is really a currency pair phenomenon?
Yeah, I think that right. I mean, I think right now you've got the reason you can have such a dramatic move like we've had, and I mean, talking about say the top four currencies, euro, yen, sterling, Swiss franc, each one of those has moved, let's say, call it 1.8 to 4% this week. All the G10 currencies are up, maybe except Canada, up about more than 1% in this past week. And I think that can happen only if like both blades are moving. That is negative things in the U.S. That's growth scare, uncertainty, and this uncertainty about the tariffs itself paralyzes activity. I've talked to many corporate treasurers who say they don't want to do anything until they have better visibility. Taxes, tariffs, what should we do with our supply chains? A lot of uncertainty. And so that just paralyzes. You're not going to make a big investment decision, maybe even a big hiring decision. Yeah, so that's a negative for the US. And there's a jump in European interest rates and a reduction of that sort of tail risk, negative tail risk for the euro. I think this is also a factor. And so I think that's what makes this such a move possible. If I'm right, and the market might be exaggerating a bit the weakness in the US, that should help temper that element of the blade. But on the other hand, we're going to get the EU finance ministers meeting on Monday, Tuesday, and they're likely to sort out more of the details about this new fiscal expansion. And so I'd be watching European bonds. So one is this, right, the news about the US, and if we get a little bit more stronger economic data, and in Europe, we want to see the bond markets stabilize, maybe even yields fall a little bit, and I think that you can see the dollar better bid. But I think that, I was in that camp that thought there was still one more push, maybe to parity in the euro. And I think that this recent price action, how impulsive it is to the upside for the foreign currencies, it just tells me that I was wrong. That maybe if we do get a pullback from this like huge move of this past week or so, that we don't go back to parity. That sort of the bloom is off the rose. For the U.S. economy, American exceptionalism is being questioned, and Europe might not be that basket case that so many people were arguing it was.
This all seems to be the new theme that a lot of people are talking about is American exceptionalism maybe coming to an end or going down that road, and Europe maybe on the path to recovery, maybe even China on the path to recovery too. Again, as you said, look at the data. But Mark, shifting back to the Fed and Powell's comments on Friday, yes, he doesn't seem to move the needle at all in terms of shifting rate cut expectations, but what do you think moves the Fed's needle here? We have the Fed meeting in little under 10 days. No one or very few people are expecting a cut, but rate cuts have been moved more earlier this year from being pushed back more to the end of the year. It seems like the Fed is more back of mind for people because of how much Trump has dominated the news. Anything, any fireworks we could see out of the Fed that wakes people up to the fact that hey, the Fed can also be market moving.
Yeah, I think you're right. I think that the Fed has been eclipsed in the short run, but I agree also that the market has become a bit more dovish towards Fed policy. By that I mean, remember what happened in December? The summary of economic projections and the median Fed forecast looking for 2 rate cuts. The market now has about 70 basis points of cuts priced in. That's 2 cuts fully, and then 20 basis points of a third cut. And this is consistent with what the Federal Reserve Governor Waller, and some people suspect that if Trump replaces Powell, Waller might be on that short list. And he suggested that there still is scope for 2, he said 3 rate cuts in the second half of the year. I think you're right too. Like, under what conditions would the Fed cut? And so I don't think it's going to be because inflation has fallen sharply. I think the most we can hope for is just a modest pullback in prices. And we still might be above target when the Fed has to resume cuts because of the other side of the equation. And in this case, it's dual mandate. I think we'll get deterioration of the labor market. And I think that's what prompts the Fed to cut rates. The market now has the first cut fully discounted for June, has a second cut fully discounted by the end of Q3, and it's got that other chance of another rate cut towards the end of the year. But again, I think that what's going to move the Fed is probably not going to, I'd put it maybe that the inflation will allow the Fed, falling inflation or slightly declining price pressures, will allow the Fed to respond to the slowing of the labor market.
Yeah, Mark, it's going to be interesting to watch what kind of news we get in the labor markets and just how healthy they are over the next month or two. And that can move the needle for the Fed because it is one of their 2 mandates. But we've talked about interest rates and how that plays into things, and we've talked about the dollar. I feel like we should also circle back to something you mentioned at the onset about gold. Gold is obviously an uncurrency. It's now one of the second biggest holdings on many central bank balance sheets right after the US dollar. It's even surpassed the euro on many central banks' balance sheets. But there's also been a move just from investors to get gold out of London, out of Switzerland, back into the US, back into Canada. Some of that is around some of these tariff concerns. Some of this is around just repatriating gold just to have it on hand. What do you make of the move in the precious metals in light of the macroeconomics that we're seeing and just the money flows here?
Yeah, to me, I sort of thought that the gold, basically, it's had a bad week, previous week. It bounces back Monday and Tuesday, but it basically traded sideways in Tuesday's range for the second half of last week. I think the consolidation still looks a little bit bullish, but I am concerned that, we've had such a strong run. Remember, middle of December, gold's trading around 2,600 in the spot market, and it goes to about 29.56. Quite a big move. And if the other markets are correcting, like the stock market is, the dollar, it makes sense that it's sort of like it's a broader market development. The rallies of Q4 are being retraced. I'm not convinced that the gold story is over by any means, but I think that's going to take a resumption. I mean, what helped the gold rally, I think, this week was a decline in U.S. interest rates and the weaker dollar. But I think you're right, though, that at some point, people are just like bought, and this fear of missing out. So as people see the stock market sell off, we've seen also gold soften a little bit, right, within this trading range. And I think that's sometimes what happens is that we think about gold as a haven, and sometimes it acts as just another risk asset.
What are you seeing globally in that picture then? Can you elaborate a little bit? We seem to have had the Western investor pick up steam. We have had gold coming into the US. The story of the last couple of years was other central banks drastically increasing their gold purchases, but I think that's been a story of the last 5 to 10 years is a shift in central banks buying gold, potentially diversifying out of the US dollar, other currencies. What is the big picture theme you're seeing globally balancing out gold and other currencies as central banks holdings?
And I'm not so sure what's happening. I mean, we have a couple places to look as resources for your listeners. One is the COFER data. That's you could Google it to put in your search bar, COFER. And that is the IMF's report on central banks' currency reserves. And they're huge. So they've stopped really growing on a net basis, which I think speaks to your point that when they reduce their holdings of one, if they're not overall growing, reducing one element lets you finance the purchases of the other elements. So you're reducing dollars, you can buy more gold like that without increasing overall reserves. I think you're right too that the U.S. is talking about revaluing its gold. Gold does seem, much to my chagrin. I'm very surprised by it. I sort of would have been in that Keynesian camp that thought, as far as monetary policy went, not as investment went, but as monetary policy went, gold was like a barbaric relic. We weren't going to go back on a gold standard. And I think there's more talk that given the abdication by the U.S. of some global leadership roles, the weaponizing of the dollar, what gold is like seems to be an easy one to fall back on. I'm still concerned, though, that when you really look at how the financial sector has grown, like the dollar value of global bonds, say, or even the value of currency reserves, and you compare that to gold, I just don't think at any reasonable price, gold can really replace the dollar or replace U.S. Treasury bonds or global bonds as a reserve asset. So you can't. So how would a gold standard work? One way it would work is you have some percentage of, say, U.S., European, Japanese money supply backed by gold. You got to pick which money supply you want to use, but some portion of that to make it credible. In fact, in some ways, that's what Hong Kong does, right? But instead of gold, they use U.S. dollars. For every Hong Kong dollar they issue, they have a U.S. dollar backing. We could do something like that with gold. I think that the vacuum created by sort of this pullback from the U.S., weaponizing the dollar, but also pulling back from global leadership, I think creates this like a transition or flux period, this interregnum. The old order is breaking down before the new orders, we're able to see the new order before the new order can rise. And so I think in this kind of uncertainty, gold becomes like an asset for individual investors as well as official, reserve managers. I think I've been long gold now for the longest I've ever been in my career, which is now only about like gold holding, that is about 6 months. And I think the last time I owned gold, it was only for a couple months. So I recognize this, and I'm long silver too for the first time in several years. I think that could play some catch up. And remember, silver and gold, we often think about them as just precious metals. But if you take a ton of cell phones, they have more gold in them than a ton of gold ore. And that really just speaks to how little gold there is in gold ore, how much of the refining process has to be done. But silver also is an industrial metal. And I think that those things, especially in the tech sector, and I think that both those just give it another underlying source of demand.
Yeah, Mark, we live in that world every day talking to the companies mining gold, and it's amazing to me how much rock they can move to get such a little amount of gold. Maybe they should be mining just piles of cell phones, then maybe it'd be a better business. But it does make you wonder. There's people that have been talking about different gold-backed currencies or partially backed by gold. People have made the argument for years. There's enough gold, you would just have to adjust the price to a level where it could actually back a market as deep as currencies, but it'd have to be a much higher price of gold. Definitely something interesting we'll keep following along with. But there's another group of investors that feel that they've got an answer to some of the potential fiat currencies or worry about this, and that's the cryptocurrencies. We don't normally talk to you about it, but Bitcoin, many of the people in that community have been making the case that it could be gold 2.0 and that it could be something, again, that would value up in price enough that it could back things and be a different alternative. What do you make of the wild action we've seen in cryptos and the idea that the Trump administration is even considering making a strategic reserve of crypto? Trump kind of ran on that campaign, but the government would be the first time I've seen the U.S. do something with cryptocurrencies if that was to happen. How are you looking at where Bitcoin fits into people's portfolio? Is it just a speculative asset for trading? Could it actually be strategic for companies to hold on their balance sheets and for banks to hold? What are your thoughts on Bitcoin and the cryptos?
Yeah, sure. So maybe let's begin off with the administration and the special crypto reserve. It's interesting, but I'd say that we want to be careful here because the federal government has confiscated during, like, say, investigations and things like that. They've confiscated a lot of crypto. So they already have the crypto. The federal government has the crypto already. They don't have to go out and buy it. And that's an important point because that seems to, if I understand it right, that's the source of the crypto, the Bitcoins, but the other crypto as well that Trump had mentioned as part of the strategic reserves. That is to say, again, we're not going to go out and buy it. We've already confiscated it. And now that we've confiscated it, and we've sold some of it already as well, but now that we have it and it seems to be a valuable asset in such a large amount, that we just want to manage it more carefully. So I don't think that really changes anything. I think it does give crypto a little bit more credibility. But at the end of the day, I mean, haven't talked to a single corporate treasurer that said that, yeah, we want to put some of our hard-earned money that we've saved in our cash reserves. We want to get rid of the dollar. We're going to take crypto. Maybe it's Bitcoin. Think about it. Companies get an interest by holding their dollars. No interest for crypto. They forgo the interest that they currently get on interest-bearing deposits, and they have to face greater volatility. Most corporate treasurers that I talk to, what they're trying to do is manage the currency exposure, manage the risk they have. Putting your money into a currency or an instrument that you have neither revenue nor expenditures in, it just is exposure. It's hard for me to separate that from speculation. And the same thing I think is true for governments. When I look at central banks, why do they buy dollars? I think they don't really buy dollars, they buy treasuries to put their national savings into. Again, with crypto, they'd have to give that up. And I think that for them, for a lot of central bankers, capital preservation is the number one rule. I don't think that the crypto like community has evolved enough to be able to offer that to like risk averse investors. And because of that, I think it ultimately limits what it can do. And again, I don't really think it qualifies for most people's, I should say, most economists' understanding of what money is. Partly because crypto, including Bitcoin, is not really used to buy goods or services. For the most part, it's traded as a financial asset, and it's not a means of exchange. And so because of that, I mean, I fully respect the explosion of crypto, of a new asset class in the last several years. But in my work, I really compare it much more to carbon and trees. Trees suck away the carbon so we don't have to breathe it in and it doesn't ruin the atmosphere. It puts the carbon in a safer place inside wood, as long as we don't burn the wood. On the other hand, I think that's what, if you think about that, the crypto, even with the pullback, say the crypto universe is worth $3 trillion or something like that. If it wasn't in the crypto space, where would it be? Chasing stocks to more ridiculous levels? Chasing home prices to even less affordable levels? So I think in some ways that just like trees are carbon suck, I think that inventing a new financial instrument sucks away the surplus savings, surplus capital that is sending asset prices to ridiculous levels on a valuation measure. My 2 cents.
Mark, that's such an interesting way to look at it. I just feel like what a rug pull it almost was for all these crypto bulls when Trump did sign that strategic Bitcoin reserve and then said, well, we're just going to fill it with all the Bitcoins that we've confiscated from people and then put these other cryptocurrencies in there. I know it caught some of the crypto bulls off guard on that one. They were, I think, expecting some actual buying, but again, I guess the government doesn't need to free up any capital if they're just taking these assets away from criminals. It's just such a nuanced view on this whole Bitcoin reserve that is now established in the U.S. We'll see which direction it goes. Mark, it's always great chatting with you. Again, Marc Chandler, managing partner at Bannockburn Global ForEx and editor of the Mark II Market website. Mark, these Sunday editorials are a lot of fun. We're going to keep on doing them. I hope you have a great rest of your Sunday.
Thank you. Good luck to everybody.